Hello, my name is Melissa Wybrow, and welcome to IBA's Engine Market Update and the impact from the COVID-19 crisis. I'm joined by Phil Seymour, IBA's President, and I'm also joined by David Archer, IBA's Senior Engine Analyst. Normally, we're all in one room when we hold these events, but we've adapted. We are now all dialing in remotely, and hopefully we won't have any technical issues, but please bear with us if we do. So when we initially planned this session earlier in the year, we expected to be sharing our typical content on order activity, historical events, shop visit forecasts, and of course, value performance. However, given the current crisis, it's apparent that what is now more relevant and valuable is to share our insights and opinion on the potential impact from COVID-19 on some of the most commonly traded engines and how it may impact values. So that's what David and Phil are going to be looking at today. So Phil, I understand you're going to start off by looking at the impact of past outbreaks.
Yeah, thanks, Melissa. So this slide we're looking at the moment is, really some of the more recent downturns. When I say that, we've got the SARS 2003 shown in the blue, and this is often what's referred to as the V-shaped recovery. I think, from the situation that we're seeing at the moment, that it's really difficult to foresee a V-shaped recovery. SARS was limited primarily, as this graph is showing from IATA. This is the Asia Pacific Airlines RPKs. So it was relatively sort of limited to that region. In previous downturns, there had been some, let's say, more global issues. 9/11 did really create a lack of confidence amongst the travelling public, but there that moved from being what I suppose was a visible enemy that could be mitigated by having increased security to something that we're dealing with now, which is less able to be dealt with visibly. So I think in terms of downturns and impacts, that we are expecting this to be a more significant impact, and especially when we've seen the recent news with various airlines all needing some form of government support. I think we have to agree that this is unprecedented. Moving on to the next slide. I think as far as the airlines themselves, as we can see here, the red curve and the global airline share performance is really showing a massive impact directly upon the airlines. Also, as well as airlines, we're obviously in a sector that includes lessors, and many of the aircraft lessors are seeing, if they're publicly traded, again, are seeing substantial discounts. So let's move on to some of the key points of this impact of coronavirus on our market with the next slide. And I mean, these are statements of the obvious, but let's just clarify this also in the context of engines, because we have been involved in a lot of aircraft discussions, but we're dealing today with engines, of course. So aircraft fleets are not flying or hugely reduced utilization. Clearly that means that aircraft and their engines are being stored all over the world. We mentioned demand and passenger confidence being down. The issue is for how long. I think we're all grasping on to potentially some relatively good news out of China, South Korea and Japan, where perhaps the initial lockdowns meant that the numbers, whilst of course tragic for those involved in terms of suppressing that huge exponential curve, there had been some success. And there's some aircraft that were stored for a while in China have now come back into service. Fuel price is down. However, whilst that is great on the cost side, it's really the revenues which are the issue for most airlines. The recent strength of the dollar, again, that can become an issue for airlines who are not earning US dollars but are having fuel prices and leasing and financing in US dollars. Clearly that's a double whammy, which isn't helping the current financial situation. So We do expect, obviously, trading activity to be down on both the aircraft and engine side, and who will capitalise on this. And this really fits into the next bullet point of cash being king. There definitely will be opportunities as airlines look to raise cash. They only have to look towards engines that may be on their balance sheet as being potential to make more liquid and raise some cash from selling those engines with a long-term lease then attached. So having painted a sort of a broad overview of where we're at, I'd like to pass over to David. And David, I think you're going to kick off with this graph, the CFM56-3 performance and what's happened in the past.
Sure. Thank you, Phil. So I think the best way to approach this situation is to see, as Phil said, what scenarios we've looked at before and how values have behaved for various engine types through different scenarios. Now, obviously, looking at this chart in front of us, we have the CFM56-3C, which is the power plant on the 737 Classic. The chart really covers the early life through to a maturing phase towards the late aughts, I guess towards 2009. And what we can see there is how those values have behaved reacting to different market trends, really. The early stage, obviously, we're looking there at newly entering into production, and really values will hold towards that baseline curve. Now, that blue line is really the takeaway from this presentation should be that the baseline curve is where you can trust values to remain and values to move around in various market events. So if there's a positive effect, you see above base, negative below, but we continuously see that value recovering to the baseline. So looking at the first Gulf War in the early 90s, really we see market values hold very, a good amount of strength, very resilient. We do see lease rate values softening in that time, but a relatively small figure, looking at towards 27,000 down towards 22,000 in terms of monthly rents. But again, that market value holds very closely to baseline, which is a good sign of strength. And that's typically what we're going to expect to see from the likes of the LEAP 1A and the GTF on the new A320neo platforms. And from the LEAP 1B on the 737 MAX, when we see that re-enter service, that's what we believe we will see as well. From that point moving forward, obviously you do see some great strength in the market as well. Perhaps maybe a rebounding effect, but more so just the market was undergoing great growth at that time, and it was during the peak production of the fleet as well. Again, it's a period of time that we've seen historically on the 7Bs, the V25s, and the 5Bs, and we're now coming towards that peak where we're seeing those fleets begin to mature. Obviously, the main event that we want to focus on here is the impact of September the 11th and SARS on the market, where you can see a real change in how the markets have behaved. Now, again, I want to restate that baseline curve is the underlying trend that you can really trust, and regardless of what's going on in the market, we do see the values returning to that. Now, in 2001, you can see a pretty rapid drop in values with public sentiment towards flight dropping off somewhat, and we see lease rates pulling down as well. But the recovery was really quite strong in this fleet. This is coming towards the end of production, but was the dominant engine of the type in service. And again, we did see a lot of confidence rebounding in that fleet. So we saw market values jump back above the base. But as we move forward from 2003, at that point in time, when you're seeing a fleet perhaps maturing more so, you do see slightly more susceptibility to a downturn. And with the market seeing a softening, we see lease rates and market values come below where we'd have seen them historically, and particularly the market value coming below base. And that's typically, again, what you're going to see for more mature platforms. I guess the comparison here would be to earlier build standards of the 7B, of the 5B, and the V25. I've listed a couple there below, and how they would react to that scenario. But again, within a few years, whilst the recovery was not to previous highs it is back to that baseline curve. And that's really the message to get across here, is that baseline drives what we expect the behavior to be. And really looking forward, we expect baseline values to perform the same. You know, the softening will occur more so for these mature narrow-body fleets and ones coming towards the end of their production life. So we're looking at, again, the 7B Evolution, 5B/3 PIP, and the V25 Select. We expect those to be resilient, but they are coming towards a stage in life where they're being replaced by the LEAPs, by the GTFs, and we may see slightly more volatility there than we would have seen a few years ago, perhaps. And again, looking towards the end of that chart, you do see the downturn from the global financial crisis, 2008, 2009. But obviously, since that time, these engines have seen a fantastic resurgence in interest in the market and in values, and in lease rates have been achieved. Now, again, in terms of looking at the Dash 3 fleet on its own today, we would expect to see quite a heavy softening. It's going to be a fleet that is not going to be as resilient as these newer narrow bodies. But this is just an indication of how we've seen this sort of engine behave through those markets. Phil, I didn't know if you had anything you wanted to add here.
Yeah, well, I think this is really important because I suppose we're in a situation where, you know, looking back is a very important part of how we can handle, you know, the questions that we're getting. I suppose we've had the added situation of the new engines that have come into being, you know, haven't actually, you know, been great successes. We've had issues with the GTF engine that's come into service over the last couple of years. The LEAP engine also has had some issues. So I think there's you know, it's a very complicated market even before COVID-19. But I think the takeaway point here, David, is really that base value curve is been pretty reliable. So I think in terms of you know, current investments, and when we're being asked, you know, what are the values of engines, I think we have to point back and say that base value, you know, holds true over time, which is actually what we're stating on that bullet point. We did have a question coming in, which I'll just answer for everybody now. Was on the x-axis we have MV, BV, and LR. Those are market value, base value, and lease rate. But obviously, if you do have any more questions, just keep them coming in. I think that's it for me on that slide, David. Do you want to move on to the next one?
Sure. Yeah, we'll move on to the next slide. So here we're looking at, I guess, a similar market. We're looking at the V2500s. This is the engine that powered the A320ceo, and we've seen a fair few iterations of that. But here we're looking at the disparity that we saw in the market between the A1 and the A5. So obviously you can see here in the early 90s is when the A5 came into production. Now that first Gulf War impact, again, you're not really seeing too much of a downturn there at all. Market value staying above base predominantly. And then with the introduction of the A5, which was a fairly early on replacement for the A1, we do see market values start to soften slightly against base, but really it holds quite steady. But the area to focus on is the behavior, again, around that September the 11th and SARS market downturn. Now, if we look at the A5, obviously that's a newer build standard, but looking at the A5 or the A1, you are seeing a similar trend. There is a softening despite the A5 being in fairly early production life compared to where it is now, obviously. But we are seeing that softening and we are seeing that recovery. But you can clearly see there's a delta in terms of the time taken to recover. And these newer build standards do recover the value faster and come back above that baseline quicker. The comparison I really want to draw here is if we're looking at the likes of the 5Bs, the V25s and 7Bs, which is so popular in the lessor community, there is going to be that disparity in how we look at an early build standard, say a 5B4/P, to a brand new, well, pretty much brand new 5B4/3 PIP. We would expect a newer build standard to have slightly more resilience. Now, in terms of lease rates, typically that is driven more so by the thrust, and we wouldn't see quite as big a disparity there. but in terms of the underlying value and the residual value, we would expect to see somewhat of a split there. Now, the A1 to the A5 isn't the perfect comparison of this, which is an area that I thought was worth highlighting. And just to be clear there, the A5 model, which is the newer standard compared to the A1, that is signified there by those dashed lines, and the A1, the earlier build model, by those solid lines. Again, since this time, both have performed very, very well. So this was a short to mid-term downturn, and long-term, those trends again have recovered to above that baseline curve, which was what we expect. The question really around coronavirus, COVID-19, is what is the duration? What is the scale? But again and again, looking back, the trends are consistent, and we do believe we will see values come back above that baseline curve. Phil, did you have anything to add on this slide?
No, but just to mention, because I've had a couple of questions on these dates on the x-axis. That yeah, we're looking back in time over here as to engine performance, engine value performance, and lease rate performance during a crisis, rather than what's happening today. Although we're using this historical data as a proxy for the situation we're in now. So that just wanted to make sure that helps everybody. No, I think that's fine on that slide, David. I'm happy to proceed when you are.
Sure. Okay. Now, obviously, we've focused a lot on the narrow body market here, and I think it's worth looking at what we expect to happen in the wide body market. There is a disparity there. The market has shifted more towards the narrow body market, and obviously away from the quad engine large wide body market towards the twin engines. Here we're looking at the CF6-80C2 B1F, and that is a variant that powered the 747-400, which was immensely popular back in some of the time period that we're looking at there. In terms of the values, now I've not provided there the baseline curve, but I think this works as a good kind of learning point. You can clearly see where you would expect that base value curve to be, and it would really bridge that gap from the late 90s to around 2007, 2008, where you see that dip in market value, you see that dip in the lease rates as well, and it really shows again that same theme. But there is also the takeaway here that we did see perhaps a more dramatic softening in the wide body markets, and perhaps a slower recovery as well. Now, the 747-400 isn't the greatest comparison if we're looking at the new wide bodies of the A350 or the 787, but there is some comparison to be drawn there. These are, new build standard engines really, and we do expect to see good resilience in them. So that's Gen X-1B, Trent 1000s, but I just think it's worth highlighting that there will be some difference in how we expect narrow bodies and wide bodies to behave. It's the same really in terms of how we look at a more mature variant to a newer build standard. We do expect there to be some delta there in how long the duration of the softening is and how quickly they recover. It's just a valid point to make there really. Phil, did you have anything you want to add there either?
Well, of course, it does bring open this whole point about the 4-engine wide body market, and I think here, what we were seeing as well in the late 90s, we also had the Asian financial crisis. So some of those let's say intercontinental 4-engine wide bodies were under a bit of pressure, and I think also that led to the part out of some aircraft, and that led to engines being available. Obviously, you don't need a mathematician to work out that it doesn't take many aircraft to be retired or engines taken off stored aircraft to flood the leasing sector. But of course, as you can see here, it did come back. I think as green time was burnt off of the engines in the market, suddenly engines that had life left in them actually became quite a commodity. So the lease rates and values came back with a vengeance. But no, I think that's fine actually. Whenever you're ready, we can move to the next slide. Thanks.
Sure. This example here, 7B26, obviously in the era we're looking at was a fairly new build standard. And I think is really the perfect comparison, obviously to the LEAP 1B on the 737 MAX, but also really to the LEAP 1A and the GTF in terms of actual performance, because looking at the early stages of the CFM56-3C on the 737 Classics, it's not quite the same scenario we're going through, and really that 2001 to 2004 period is the ideal comparison, I suppose. It's not a perfect comparison, but it's the best one we can have a good look at the data on. And clearly you can see here 7B26, very popular engine choice. We do see that softening in value. So we're not trying to suggest that there will be perfect resilience from these new build standard engines. They are going to soften. We are going to see softening lease rates on that right chart and softening market values on that left chart. But we do provide their upper and lower bounds. And you can see that lower bound dips quite heavily, but the upper bound of where we see market values, that holds quite steady. There is still a dip there. But again, a very, very quick recovery and a very, very sharp recovery, really from 2004 onwards. If you look at the chart on the left, those market values really pick up very, very quickly. And that's really the trend that we're going to expect to see on those new narrow body engines. Again, looking on that chart on the right, that's the lease rates. Perhaps more stable, but obviously it's a plateau there in terms of the lease rates you're seeing, which is not ideal at that stage in the platform's life. But again, very strong value growth from there, lease rate growth from that point. Again, you are seeing that dip towards the end if we look at the global financial crisis. But this is also a point worth noting where there is that difference between how lease rates react and how market values react. There can be some lag there, and the lease rates can be more volatile. So 2009, whilst we see market values hold fairly consistent, and really, beyond that point, the market value trend is fairly steady and continues to grow. Lease rates did have a dip before a recovery, and again, that may be a trend that we can expect to see in current build, current generation narrow body engines. Phil, anything to add there?
I suppose here it's is it fair that the Dash 7B engines on older, I think there'll be some difference here, aren't there, between 7B engines on older NGs that may be parted out or lower utilization now. Do you think the 7B curve will follow more like the 3C curve that we saw earlier, or is that is it a different market now? I mean, I suppose I see when the Classic was going out of service and the NG coming in, we're kind of in that phase now. But of course, we've got the issue over the MAX, so that's really the unknown quantity. And of course, the numbers of MAXes that should be produced would potentially have put more pressure on the 7B engines on the NG. But I don't know, I suppose we have to see where the part out market goes on those and how robust the conversion market is for the 737 NGs given the current situation. So I'm really asking more questions, really, David, and I don't expect you to answer them all now.
I mean, I think your point there in terms of do we expect earlier build 7Bs to vary compared to newer builds? I think that's a fair point. It's been a long production life. It's been a very reliable engine over that time, but there is likely to be that separation. I think I highlighted that on the V25 chart, where whilst it's not a perfect example of it, we will expect to see a difference in how a very early build 7B26 would react compared to a 7B26 evolution that has just come off the line. But again, they are a very similar market to each other. One slightly further down the line, but we're not going to expect to see one market, really suffer and one market be incredibly successful. They should have similar trends, but perhaps the level of softening and the rate of recovery, I think those are the points that you're going to see a delta on.
Okay, good. Thanks for that. I'm happy to move on if you are.
Sure. Yeah. On to the next slide. Right. So I just wanted to summarise here really the points we've covered there. and what we expect to see based on what we have seen before. Obviously, the scale of the COVID-19 outbreak and the impacts had on every market really is something quite unprecedented in this day and age. But in terms of short term, what we expect to see, lower transaction volume. We have seen a number of deals where people have backed out, and where not so long ago people would have been very keen to get involved. Softer lease rates. Again, this is really something in the short term that we expect to see. I know in the midterm we expect to see those probably likely pick up. Low utilization and therefore demand, that may also have a knock-on effect on part out activity, and obviously on the MRO industry as well. We started to hear feedback, from MTU and Lufthansa Technik that it's having a pretty profound impact on their work stream, workflow already. New engines, we expect to see quite a bit of resilience there. I think it would be surprising to suggest that we didn't see a softening. Typically at that stage in the engine's life, you expect pretty good escalations year on year in terms of the market value, driven heavily by the list price from the OEM. But whilst we may see a softening, we expect to see a pretty good recovery longer term. Mature engines, again, probably going to see a harsher downturn. If we look back to that -3 chart, you saw once we passed that peak in base value, which is a fairly standard outlook for any engine, we start to see it becoming more susceptible to market downturns. Again, mid to long term, still recovering to those base value curves, but more susceptible. And a similar relationship comparing narrow body to wide body. Not to say that wide bodies are going to suffer, incomparably to narrow bodies, but we would expect to see more of a softening and a longer recovery time to that base value. Midterm, as I mentioned, operators are going to seek to offset that maintenance, and what that's likely to lead to is going to be increased lease demand. So potentially more sale and leaseback activity, but also just engine leasing activity and potentially lease rates. I know there's been some pressure for some time on the newer model engines for lower lease rate factors, so maybe we'll see some improvement on that. Market value recovery, it will depend again on what kind of engine we're looking at, but we do expect that to begin, and by the midterm, I'm talking beyond a year, towards a year and a half or two, I would expect, from what we've seen before. And again, the narrow body markets recover first. The LEAP 1A, LEAP 1B, and the Pratt & Whitney 1100G, or the GTF, those will recover first, most likely. And then you're looking at the previous generation, the 5Bs, the V2500s and 7Bs. That would be an area that I think you can be confident you will see a good recovery. It's still a very large, high demand fleet. And long term, really looking at pretty much any engine type, the base value curve is driven by the underlying dynamics that market represents. So we still expect to see a recovery to that point. When we see the dust settle, we'll start to see the trends hopefully back towards normal. But long term, we are expecting to see values return to base and hopefully back above in the hopefully not too distant future. Phil, anything you want to add there?
No, I just wondered, before we go on, I've had a question on the previous graph actually. Can we go back to the previous slide, Lucy? The CFM56-7B26 performance. It was just clarifying, yeah, thank you. Could you just explain the positive and negative references on these graphs?
Sure. I mean, these will just be upper and lower bounds. Obviously, we reach out to the market intensively, and this is a period where we're doing that a lot as well, trying to understand what the dynamic is. And at that point in time, you will see upper and lower bounds of where you're seeing trading values being achieved. Some of these may be slightly softer market transactions, and some of them might be somebody in perhaps a more desperate situation and willing to pay at a higher price. This is just to give you an idea of the upper and lower bounds of where we typically saw transactions at that point in time.
Okay, and would those have also been based on the condition of engines? A run-out engine obviously being negative and an ex-shop visit being positive, or are these normalised for half-life situations?
Exactly, normalised for half-life situations. You can't really compare engine transactions. If you're looking at a run out to a full and say one's a lower end and one's an upper end, you have to normalise to that half-life condition. So looking back at any of these charts where we provided that market value, we are looking at that half-life value condition.
Yeah, okay. Yeah, thanks. Sorry to go back, but I thought we'd deal with that question before we got too further on. So you provided the summary. I am going to come back with a few more questions on that because I've seen a few more come in. But actually, I think if we go on to that A330 market, I mean, ultimately, all engines, I know engine people don't like me referring to it like this, but the value of engines really depends on the host aircraft situation. So we've got some of those coming up here. So David, can you just run through the A330 market and what issues the engines have had there, or where we see that market?
Sure. I mean, there's two additional markets that I want to go into. One is the A330, because I think there's something interesting to be said there, and also the GE90, which we'll go on to shortly. For the A330, the first thing I want to do here really was just kind of show why it is that we treat some of the engines a bit differently on this platform. And clearly you can see here that despite there being 3 engines on the platform, the Rolls-Royce Trent 700 has really taken the dominant share. Over 60% of the market is Trent 700s, and particularly if you're looking at in terms of when those were built, the newer build engines and the remaining backlog has heavily focused on Trent 700 engines. So how we look at those has to be different. One is perhaps a more mature aging fleet, but there's also that split in how the aftermarket is run for those. And that's a very common question around these engines. For the Pratt & Whitney 4000, the CF6 engines, there's the tendency to see a more open aftermarket, but that has also led to, in some cases, a lack of investment in maintenance, and therefore we're seeing premiums in engines, particularly in higher thrust configurations, whereas the Trent 700s are within the Rolls-Royce ecosystem, and typically when we're looking at those, really we appraise them from a full life standpoint. That also does mean that we look at residual values differently, but I'm hoping it's an area that we are going to see some changes. And if we move on to the next slide. So here we're looking at the CF6-80E and the Pratt & Whitney 4100. Now I just wanted to look at these as a comparison to the Trent 700, but really what we're seeing here is those charts on the left are showing what the makeup of the age of the fleet is. So you can see the CF6 is a bit more of a focus in the mature fleet between, say, 11 and 16 years, with a slight peak again at 4 to 5 years. The Pratt & Whitney 4100, again an earlier peak, but then again a ramp up until about a decade ago. At which point, from there on, you're really seeing Trent 700 dominance. And again, just to reiterate, these fleets are now in a position where you're seeing that shift towards higher thrust engines in a good condition are getting a premium because there's a lack of investment in the maintenance in some areas. Now, if we move again onto the next slide, here we're just focusing on the Trent 700s. Now, this is an area where we do see these engines in leasing portfolios, probably more so the CF6s and the Pratt & Whitney 4000s. But this is an area that's becoming an increasingly common discussion point, is where do we see the Trent 700s, particularly in the mid-term. Now, that outlook is heavily linked to how Rolls-Royce is working with that aftermarket, and we are seeing signs of it opening up, which is very interesting to us, because that is a bit of a test to the statement that Rolls-Royce reiterates that if the fleet is of the right size, the right maturity, you will see that opening up of the aftermarket, and it becomes a very interesting investment compared to where it is right now, where it's more of a niche, and typically the engines you will see more so in Rolls-Royce linked leasing entities. Now, if we look at engines that maybe this would relate to, I've listed there the 900, the 800, and the 500. Those are fleets that we really wouldn't expect Rolls to open the aftermarket up for, purely in terms of the scale and the number of engines that are out there and the maturity levels of them. But we think this could be a good comparison when you're looking at some very popular engines at this time. So the Trent 1000 going forward and the Trent XWB. Now, obviously the Trent 1000 has its issues, but long term, we still believe that will be, inverted quotes, so teething issues. But we're hoping to see that if this behavior continues and we see the Trent 700 aftermarket opening up, we will see improved residual values. We'll see the asset become much more liquid, and we see it as a good test for how the Trent 1000 and the XWB could be treated in the future. Now, obviously, going back to how we've seen the COVID-19 outbreak impacting the markets, these are the kind of engines that we do see as being, midlife, probably likely to see a downturn in values, and that's inevitable. We hope that on the tail end of this, we may see the Trent 700 becoming an interesting asset, something that people are more open to getting involved with if we see that opening up of the aftermarket. It's still in the very early stages. A few engines going through the TSMS shop, but it's an area of concern for some of our contacts in the industry, and it's an area that I want to touch on briefly. If we move on to the next slide again. So this is the GE90, which powers the 777-300ER. So we're talking about the GE90-115 largely. And now have been questions around this in terms of the number of lease ends that we have approaching, and how we're treating the values, because over the last few months has been an overall softening we've seen in the market, and as such we have had to readjust how we've looked at the engine. But our outlook is still strong, because there's a good operator base, and despite the concerns around COVID-19, I think, Phil, you were making a point to me previously that we hope to see a lot of these lease ends being picked up, and we see potentially an improved outlook for this type compared to where we're looking at it pre-COVID-19. There is still the question around who is that secondary tier of operators, with the cost of maintenance involved, cost of the asset, and just the liquidity around it. And I've listed on the right there a few of the operators, and clearly these are top tier flag carriers, so there is still that concern around there. But really, it has been a very healthy fleet for some time, and we look at it quite positively longer term as well. But again, a midlife engine, high cost of maintenance, there's maybe one that we see a bit of a downturn in the short term, but we hope and we believe we'll see it recover to those base value curves that we provide. Phil, I didn't know if you had anything to add on that slide.
Well, yeah, you brought up something I'd alluded to when we were putting some of this content together, and something I picked up on some other industry webinars we've had over the last 2 days or even the last week. I think, when we look at the current situation, we've got a situation where some of those Middle East carriers are really deciding that their A380s are just far too big. I know anything is too big at the moment because everything is grounded, but it's really perhaps focusing the mind on how these A380s and 4-engine wide bodies, how they can be usefully deployed in the future, and I think they're going to be under considerable pressure. So therefore, if we look at this on the right hand side of this slide, you've got operator and the number of aircraft, and if you look, Emirates have still got 155 777s there, Qatar 57. Moving down the list, Saudi Arabian Airlines, actually I won't include them because they haven't got A380s, but if you look at this list of airlines and how many of those have got A380s, which are clearly under pressure, I wonder whether this means that the 777-300ER and actually the A330s from the previous slides, whether the twin engine wide bodies will actually become more favoured than their bigger family members. So I think we could see a number of lease extensions to 777s, or even if the aircraft are owned, maybe not retired as rapidly if those airlines have got larger aircraft which may be preferred to be retired first. And so I think that we won't know. That's just my inkling from an airline fleet management point of view. If you've got an option to use a smaller aircraft rather than a larger one, you will do that. So that's why I see some potential positive lights for 777-300ERs in terms of lease extensions. So yeah, I just wanted to make that point. I think as far as we do have plenty of questions that are still coming in. So actually, we've been running for 40 minutes, so I think I should give at least 10 or 15 minutes to questions. And David, I'll put you on the spot on a couple of these because something I know in the original slide deck that we had that we pared down, you did have some information on CF34, and having said that we should delete it, I'm now telling you we've had several questions from people saying, what about the regional engine market? You don't have to answer anything specifically now, but we do have the content that we can add to this slide deck, I believe. Is that correct?
Yep. That's all prepared and ready. We can add that when we send it out. But really, I mean, the takeaways were really heavily driven by what we've seen in the market building up to that point, which was we've seen some recent strength in the 8C market that we believe was probably coming towards the end of its peak, but it had been performing very well, been a good asset. The CF34-8E on the E170s, again, doing very well, whilst the scope clause is still an issue. E190s, there was concern on the CF34-10Es, that is, around the cost of maintenance. That's really kind of an ongoing commentary there. But we had seen quite recently the OEM had made some efforts there, and we were seeing used material coming into the aftermarket, which is a potential positive there, though maybe a little bit too late. But in terms of the CF34 market, I would hope to see that would behave in a similar vein to the 5B, 7Bs, V25s. I think whilst it's not quite the same scale of the fleet, I still think there's a very good demand there, and there has been for some time. So I would expect a similar recovery. Yeah.
A more sort of general question come statement on this, of course, is that we know, of course, that the engine market is different to the aircraft market for various reasons, but one, of course, is the amount of OEM control that there is in this area. So I think as a general statement, I mean, is it fair to say that some of that historical recovery, performance recovery in lease rates and market rates, that the OEMs have been an influence in that because they've actually been able to manage production rates better for the spare engine market?
I mean, I think that's a very interesting question, and there's been an ongoing debate since I've started, with IBA around, the OEM's presence in the aftermarket and what that does to the resilience of values. But I think at this point during a downturn, yeah, maybe it could be a positive and could help see some resilience in the fleets that are more dominated by the OEM.
Yeah, I mean, that would be my sort of intuitive view. But of course, then we've been asked the question, this is why I've sort of raised that point, and I'm glad you agreed, David, is that actually because of the entry into service issues that we've seen with the GTF and LEAP, that now there is the potential that assuming the market recovers generally, that in order to fix some of the entry into service problems, that could create oversupply in the LEAP and the GTF spare engine market, and that could cause a softening of values in future years. Is that a reasonable assumption?
I mean, potentially. I mean, in the last year, we've seen, just more and more interest really in the type. And obviously, the events we've had in the last month have changed that somewhat, but really the GTF was a high demand asset despite any teething issues. People were working hard to get their hands on it, particularly as Pratt & Whitney had held on to those spares for a little while there. And the LEAPs, again, the teething issues that were there have largely, I think they're largely in the past. Now there's still some remaining, but it seems a very good asset. I think there is potential that we may see, more interest in the slightly more mature engines in the leasing market, but really, I don't see too much of a softening in the newer generation engines. I still think that's going to be a strong point in any portfolio.
Okay. Yeah, I mean, I think this does, this whole thing about engines, and we probably need to revisit this on another webinar in a month or two, hoping that things will have settled down, because there's a lot of questions, I think, for the MRO sector as we sort of touched on here, how will this impact the shop visit program? I mean, clearly at the moment, things are in lockdown, so I don't know whether there are many engine shops open. I don't know how essential they're seen by the various governments as needing to be kept open. But it's a lot of the engines that go through shops are subject to fleet hour agreements or power by the hour agreements, and of course utilization is dropping. So some of those subscribers to the hourly fees, that there's probably minimums that have to be paid. So I think there's going to be a lot of, let's say, renegotiation of some of those, as we're going to see with aircraft leases. I think the same thing will happen with a lot of these MRO contracts. I don't know if you've got anything to add there, but it's kind of just a statement that there's more to it than looking at base values and market values here. There's going to be significant issues to sort out across the whole of the engine sector.
No, absolutely, and I have seen reports coming out of MTU and Lufthansa Technik, which I mentioned earlier, but yeah, they're not going to be having a good time for the near to mid-term, really. And I think, whether it's cancellations now or just operators offsetting investing in further maintenance, I think it's going to be a weak time for the aftermarket, for the MRO aftermarket for some time, which has really been a key driver of value for recent history, really. So that's going to really change some of the market dynamics that we've seen recently.
Less of a sort of conceptual question. In the summary slide, we referred to short term, mid term, and long term. We've been asked, what we see as short term. Is short term sort of in the next 12 months? Is that short enough, or is it more like 6 months? Have you got any particular views on that, and then what mid-term and long-term mean?
Sure. I mean, it's hard to quantify, really, because we're looking at past examples which just simply aren't on the same scale, and that's in terms of the outbreak and in terms of the scale of the fleet that existed at the time. So there's going to be an open question there, but in my mind, looking back historically at what we have there, long term, I think you're looking at kind of potentially up to 4 to 5 years. It really depends on the fleet you're looking at and how they're going to react. Short term, I think, yes, probably up to the next year. I'd suggest that would be that kind of period. And then beyond then, when we're talking about seeing lease rates picking up, I would hope to see that within around about a year or so, yes.
Yeah, I think there's one of the questions we had said that we, looking back at some of the recovery in lease rates and values, that it was kind of a 2 to 3 year period. And if we assume that this downturn is more impactful than some of those others, then it could be more than 2 to 3 years. It is difficult because if I put a sort of my general appraiser's hat on, the difficulty we have when we're putting values on aircraft or engines right now is that we're often criticised as a body if we start showing reduced market values before we've seen any transaction points. But I think we should be given some credence in terms of the numbers of down cycles we've seen, either as individuals or in more recent years. So I think it's fair that we're asked, well, what's happened in the past, and I think it would be silly if we were to say, well, there's no impact on base values or market values because we haven't seen any trading points yet. We have to look back in time to figure out how things will go on in the future. So it turns out, David, I mean, we do have our new version of Engine Values book just about to be published, don't we? But can you tell us how that's sitting at the moment?
Yeah, I mean, that's currently undergoing QA, and that should be out next week. Obviously, the market values in that are going to be pre-COVID-19. As you say, I mean, we can't lead the market and suggest where the value should be until we've seen transaction points.
Yeah.
So I think really the focal point on that should be our base values and our base value curves. But we're kind of we're at the tail end of the production. That should be out, I believe, end of this month. That will be published.
Yeah. Just to clarify, we've been asked about base value, and really per the ISTAT definition, I don't have it in front of me, but just to give you a feel of it, base value is all about the long-term underlying economic value of an aircraft or engine. So that's why we focused a lot of that on the first charts we were looking at, was saying, this is where we saw the base value curves. And of course, any aircraft or engine, we have a feel for how long that production cycle will be. We know how big the backlog is, so we know how robust the program may or may not be. So that's why, as appraisers, we develop our base value curves for each engine in production, and in fact each engine variant. So a lot of research goes into that to establish the base value. I think the last question I have here relates to how engines have been funded through various capital markets situations, and that actually brings me on to a point that we are actually going to be running an ABS webinar next Thursday. I think that's the 2nd of April, and we are going to cover both aircraft and engine ABSs, because we are aware that there's a number of engines which are subject to those types of structures, and we're going to devote a particular webinar on those structures next week. So I think, as far as I'm concerned, I think we're just about there. I haven't seen any more questions coming through. Those that I didn't answer were either so complicated I didn't want to put myself or David on the spot, and we'll get back to you individually. But at this point, I was going to hand back to Mel. Are you happy to wrap up, Mel?
Yep, thank you, Phil. So thank you, Phil and David. Some very useful and interesting insight that we hope has been helpful to everyone that's listening today. I just want to add that we are using data from IBAIQ, our data intelligence platform, specifically from the engine module. If you've not had a chance to look at that yet and you want to have a look, we are offering free trials of the system, and you can register online, or once you've sent the slide deck out, there's a link on this last slide here that you can see on the screen. You can click on that and fill out the form, and we'll set you up. And just to confirm that we are sending out tomorrow the slides and a link to view the recording if that's helpful. And as Phil has mentioned, the next webinar that we're running is the ABS market, and that's a joint session with Split Rock Aviation. So I think that's it. So on behalf of IBA, Phil, David, and myself, thank you for joining us today, and goodbye.
Thank you.